Good morning, ladies and gentlemen. Well, over the course of the week, the risk dial fell quite a bit. It's now at 28, which is a one of those I don't know scores. It could flip either way and very quickly. But what is very clear, and especially in a week when we are going to have the big tech earnings, is that the volatility in the technology sector is still very, very contained. And it's that technology sector which is going to decide the direction of equities and risk on and risk off for the next several weeks. So we will pay particular attention to technology as usual, but that's for later on. And I think that technology is actually going to react to what the yield curve does. And so, therefore, let's have a look at the bonds and the yield curve because they are at very, very important levels. And we have to understand what a change in the shape of the yield curve will actually mean. Let's start with the outrights, and what is clear is that the two-year note is absolutely stuck. Again, we had Powell that came out and basically reiterated what the other Fed governors have been saying, and that is that they are probably comfortable at this level for the time being until they get more data. The odds of them actually doing anything on November the 1st are almost zero, and even the odds of them doing something in December have fallen down to 20%. So the market is saying that it agrees more or less with the Fed that short-term rates are going nowhere, and it's all about the shape of the yield curve going forward. So twos, absolutely nothing going on. Fives, tens, and 30s, they are all going up to various degrees, of speed. Here you have the fives, smack on the 486, that's where it closed the week. And where is resistance? Resistance is up here around the 515 area, 518. Basically, what this is saying is I don't know. And I don't know either, and I will explain to you why, and that is why I'm keeping quiet and I'm keeping my positions very, very small, because we are at very pivotal levels where it's very tough to actually say what is going to happen next, and I'll explain it to you. Tens, I mean, how much further can they go? Can they go up here towards the 517 area? Absolutely. And 30s, that's the one that's, really has no top until we get to the 525 area, which is a very long term. And I'll change that to the weeklies. If we have a look here, this is this kind of area. You're talking about 5.25%, and that really is as high as we have seen it since 2004, and through there, and it's a completely different game. Let me tell you, I do not expect that to happen. We are, within 20 basis points of a top for the time being, because if it's not a top, we change the game completely, and I'll try to explain to you now why it's so unlikely that we go through. First of all, let's have a look at the shape of the yield curve, and let's have a look at this hump that exists in the yield curve. So twos, I've told you they're going nowhere, and anything from the T-bond out to the ultra is still going up, but it's more or less at the same level as the twos. Now, why does this hump here exist? Well, it exists because Powell has told us many times that as inflation falls, they are going to have to reduce the Fed funds rate to try and keep real rates from rising. Let's say that inflation is now 3%. Okay, so they've got Fed funds at 5.5%. That gives us 2.5% real in the short term. If inflation now falls to 2%, they're going to have to reduce rates. Otherwise, real rates are going to are going to rise. And really, why would they want real rates to rise from a 2.5% real, which is the highest we have seen since, 2000? It doesn't make any sense, right? And that is why this hump exists, because the market is saying inflation will fall. If this hump is now taken out and we go to a straight yield curve, completely flat or even positively sloping from the twos, that will be the market saying inflation isn't going to go down. Inflation is actually going to remain stable to go up. And that would be a sea change in the way that we think about what the economy is doing. So now that we've understood that, let's have a look at the butterfly that I've been talking about. And this is it. This is the 2s, 5s, 10s, 30s butterfly. And let's take it down to a daily and try to understand what this will be saying. Remember, this is 2s, 5s, 10s, 30s. So if it goes down to 0, that will mean a completely flat yield curve. 2s, 5s, 10s, and 30s will be yielding the same level. Flat yield curve. Where are we now? We're at 40 basis points, so we are not really indicating a lot. The big question for the market is this butterfly a buy or a sell? I am having a very tough time believing it can go down to 0. So I'm really changing my mind from what I've been saying all week. I would rather see it at this kind of level, 17, 18, to buy it, because I really don't think we are in a position to say at the moment, with the data that we have, that inflation will not fall. To me, that seems to be a bit fantastical, and therefore I seem to come to the conclusion that this butterfly is reaching unsustainable levels, and that hump that exists in the yield curve has to be there. Whether it's more pronounced or less pronounced is neither here nor there, but it has to remain above 0. So the further this butterfly falls down towards 0, the better the odds that, of buying it for a return towards this kind of level, 50 basis points. I hope you're following my logic, because if we really now say that inflation isn't going to fall over the course of the next couple of years, then we're in a completely different ball game for everything, for every asset. Because if inflation is not going to fall, and then the Fed is going to have to reaccelerate hikes, or it does nothing and the market prices in the hikes, then all you really want to own is gold, tips, and equities. But if you believe that the Fed is going to get inflation down to 2% or heading that way over the course of the next couple of years, either because it will react to any resurgence in inflation through higher rates, or because inflation is going to fall all by itself down towards that target with them doing nothing, then the likelihood of this butterfly getting to zero and staying at zero are almost zero. There has to be a hump in the yield curve, or the yield curve has to be positive, one or the other. So what happens to this butterfly over the course of the next few weeks, to me, is pivotal. And I'm reaching the conclusion that the odds are that you buy it at around the 15 area, if we see it, rather than you sell it when it rallies towards 55. So now let's look at a pivotal component of that butterfly, and that's the 2s, 5s. This is the kind of level that you want to be long of it, i.e. short of 2s and long of 5s, anywhere between 0.5 and 13. Because, again, if this hump does not exist, then we are in big trouble. And you can just stop yourself underneath there, weekly close below 0.5, and you are the hell out of it. So what I'm saying is that I don't believe that this inversion will continue indefinitely. So let's have a look at the 2s, 10s, and that's rapidly falling towards zero as well. And this kind of level, zero, I think you want to start fighting it. Don't forget that we have the QRA in 2 weeks' time, and the market basically is afraid that the same thing that happened on August the 2nd is going to happen now for this next QRA, and it's basically setting itself up for a sell the rumor, buy the news kind of fact. Unless the QRA is absolutely horrific and we're going to get hundreds and hundreds of billions more in issuance, it's very unlikely that the yield curve completely flips and that butterfly goes through zero or stays at zero, in which case the components of the butterfly should be very well supported at zero. And that is what we're going to be looking at, and that will be our lodestar for the next 2 or 3 weeks. Next week we have the ECB, and we'll look at the spreads against Germany now, and then we are going to have the FOMC, and at the same time we're going to have the QRA. So the next 2 weeks are absolutely pivotal for what is going to happen in the longer term. Now, I might be completely wrong with what I've told you here, because if the QRA is absolutely horrific, they're going to take that hump out, if not in the 2s, 5s, certainly in the 5s, 10s, and the 10s, 30s. So that is a third alternative. But don't worry, I've got all these alternatives in the back of my mind, and I've got all the levels written down, and I'll be tweeting to you if and when things change and my mind changes. But what I'm trying to make you understand is that we are at such pivotal levels, we're not going to stay anywhere near here after the QRA and after the FOMC. There will be very big moves, and I just don't want to be caught on the wrong side of the market because there's no point. I mean, why should I now get into a trade and be 5-10 basis points underwater, and after the QRA be 25 basis points underwater? I much prefer, in terms of risk reward, to wait, understand what the levels mean, and then act after the QRA. Now, this is an interesting chart. It's 3-month money against the 5-year note. As we saw, 3-month is absolutely stuck. And as I told you at the beginning, the odds of the Fed hiking even in December are at 20%. So what we can say with a high degree of certainty is that the 3-month is unlikely to move. So any movement in this chart is going to come nearly 100% from the 5-year note. What would happen if we started falling below this level, this, 110? Well, the next support will be down here at 85, and that's 25 basis points below. So what we would be saying is that the 5-year note is going 25 basis points higher. Why would the 5-year note start going 25 basis points higher? Well, it can only be because the QRA is absolutely horrific, and that is probably the one that we should be playing if the QRA is horrific. Something like 2s 5s, 5s 10s, 10s 30s, it's all going to steepen out, but I don't think that that kink that I showed you earlier is going to be taken out completely, because then that is saying that, as I told you earlier, that we don't believe that inflation will fall at all. This is what could happen, is that we still believe that inflation is going to go down, but it's the very short end against the 5 years that gets pummeled another 25 basis points. So I'll be watching this chart like a hawk. We have the ECB this week, so let's have a look at what those charts are saying. 2 years as dead as the 2-year note in the US. Basically, stuck in a 30-40 basis points range, and it's going nowhere. I think the ECB is going to, do a hawkish pause, and this is more or less the appropriate level for the 2-year note. I would be absolutely stunned if they hike, and I would be stunned, given what their economy is doing, if they don't say at least that they are looking at the real economy and the performance of it and the data, and that they will act, how can I put it? They will take real data into consideration, and from that real data decide whether it's appropriate to hike or to cut. So some kind of optionality in their language that is not completely hawkish. So 2's completely stuck. Bobble, I think it's pretty stuck as well. As a result, I'll be very surprised if we start breaking and maintaining breaks of the all-time highs. And 10's, still the tendency is to go up with the 10-year note in the US. But what to me is very significant is if we look at the butterfly between Germany, US, and Italy, we have reached levels that, to me, were the target. So this is short of 10-year notes and short of Italy against long to Germany's. And the rationale was always you short the countries where issuance is going to be the greatest, and you own the country where the issuance is going to be the least. Well, as you can see, and let's go back in time, these are very, very, very important levels. We can even change it to a weekly and see how far back we go. Very, very important levels. If it starts going through here, it's because, and only because, either the QRA is so horrific, or the Italian market gets downgraded next week by where it is, Moody's, I believe, and then we start, going down another 100 and something basis points. But that will signal acceleration. So if we have a look, here we have the situation that we are in. I think playing it here for the next couple of weeks is, just plain gambling. You really don't have any kind of edge. And really, this is the place to take that off, which also means that the probabilities are that it's time to take off the Italian leg of it, i.e. Italy, Germany, that we are probably going to see better levels on the downside to get back in. So if we have a look at that on the dailies, we are very much stuck in this area at the moment. The market is waiting for, is there going to be a downgrade by Moody's or not? The S&P didn't, kept it at stable, so probably it's time to get the hell out and only reset it at these kinds of levels around 188 down to 185. I don't think there is much of a chance that we go and revisit the 172. If we did, it would be a gift, because still the issuance is going to be there. So the rationale for this move, while there might be quite a bit of downgrade fear, it's still the right one. It's still the right direction. So anything around here, I think, is going to be a gift, and that's what we're going to be looking to do. Let's now have a look at the other part of that butterfly, which is the 10s US against 10s Germany. Very proud of the fact that I got you in on the way down and also on the way up. But if you have a look, we are at extremely, extremely pivotal levels here. The risk reward here at 202 is 0 compared to what the risk reward was down here below 170 and at 170. To me, if you start playing here, you are anticipating the QRA. You are anticipating basically what could be a gigantic sell the rumor, buy the fact. I think the odds of playing here are so much against you that if you are long of Germany and short of the US here, you are asking for trouble. Best to be out and wait for the QRA. We got the move up, we got the move down before that. Let's not be greedy and think that we can, catch all the way up to something like here. There's plenty of time. If the QRA is exceedingly bad, and don't forget we will have had another 2 weeks of sideways, hopefully, then we're going to 220. Okay, there's absolutely no question in my mind 220 is the next stop. But why anticipate it? I just don't get it. That's a 10% move, okay, to 220, and we'll get it without a doubt. We'll talk about the QRA and the exact levels, the exact quantities, rather next week. But, risk reward, get the hell out. So now this is the 30s. So the ultras against the Buxel, basically in futures terms. And we are at the same kind of level as the 10s. Just this 200 level, 201, is so pivotal, as you can see, that you have zero edge here. It could easily come back to 175, not next week and not probably, not until the QRA. But if the QRA is bad, I expect that to go to at least 216. That is the kind of level that I expect it to go, and same message as from the Bunds against the 10s. Get the hell out, wait, let's see what the QRA brings, and then we will know whether we're going to 216 or this 201, 202 was the top. Because if it's not the top, it signals acceleration. And I don't think the move is going to come from the Buxel. I think the move is going to come from the US. So we will be able to triangulate things much better in 8 days' time than we can now. All we can say now is that we are at very pivotal levels and the market has got us to exactly where we want it to be. So let's not be greedy. Let's take a week off and chill, and then we will know what we need to do after that. And chill for the next week or so seems to be exactly the same message that the DXY is giving you. I've been saying for a couple of weeks that I think the risk reward of buying it here is not great. Now, let's put that in yield differential terms. As I've shown you just now, we've reached all the targets for 10s, 10s, 30s, 30s on the upside, Germany, US. What happened here is in the DXY is that it's been leading or anticipating the change in differentials. And it's achieved them, and for the past 2 or 3 weeks, it's been chilling. So it's basically a buy the rumor, sell the fact. And now it is waiting, just like I think the interest rate differentials will be waiting for the QRA and for a decision what to do with the yield curve. Do we continue selling duration or not? Because if we continue selling duration, it's certainly going to be in the countries where it's being issued rather than the countries where it's not being issued. So that's, to me, the same message. We trade around in this 107 something to 105 something, and if we look at in terms of Euro USD, this is the kind of level, 106.50 to 106.80 that I can't see it going through, not before the QRA. I really wouldn't do anything in Euro USD for a while. It's going to move the same way as the differentials between Germany and the US. And at the moment, we have no edge. Gold has gone a lot further than I thought it would. When I say a lot further, 1%. But I always said 1958 was, a distinct possibility. It went through. It likes to screw around with people, but I can tell you that I've sold every single ounce of gold I possess. I, for the first time since God was a boy, own 0 gold. Why? Because I prefer 2.5% tips. But that's just me. For gold to start going higher, we would have to believe that fiscal dominance is around the corner. Either that or the Fed is about to abandon its inflation targets. I don't think the Fed is about to abandon its inflation targets, and I don't think that inflation dominance is around the corner. And certainly 2.5% real, to me, is always better than 0% real. I have faith that the United States will be only as stupid as the markets allow them to be stupid. And to me, these kind of levels in gold are approaching a mega sell relative to something like tips. We'll have a look at that in a moment, but as far as outright levels in gold are concerned, you're looking at 2045, and there I think on an outright basis you definitely want to try to do some kind of a put spread or sell call spreads or whatever, because I really think that that will be the height of ridiculousness unless there is a major geopolitical turnaround. But I think at these levels, gold has discounted the kitchen sink as it is. We would have to have, I don't know what kind of escalation for gold to actually start going through here. So let's have a look at GLD against tip, so gold against tips. Some people look at this chart and they say clear uptrend, gold is going up, tips are going down. Until you do this, and this is the adjusted chart. And then you do this and you go for the 1 week and you have a look at basically all the way back from 2005. So what have we done? We've spiked. Can we go a little bit worse? Yeah, absolutely. But I think the long-term average is somewhere around here, and that is a big, big move in relative between tip and gold. I will bet my bottom dollar that over the course of the next 5 years, we trade here more often than we trade where we are. That's because 2.5% is real, is a hell of a headwind for gold, which yields you absolutely nothing. I will bet my bottom dollar that we trade this 135 to 140 level again and again and again over the next 5 years. The thing that makes me think that we are very unlikely to go much higher in gold, and that we are very unlikely to get very much higher nominal and real rates for the time being, is oil. Because let's face it, what has the US announced? It has announced that it'll be buying oil at $79 for the foreseeable future. I mean, all the way up to May, and it'll be buying it at 79, and it has to refill the reserves. Now, here we are. This is 79. As you can see, actually 79 is a very, very important level. You have all these lows and all these highs. So let's put this at 79 exactly. So some people say that I'm not cheating. Here we are, 79, dead. Okay, so where's the 200-day moving average? Well, within a week or so, or 2 weeks, immaterial, it's going to be at 79, isn't it? So basically what the US is telling you is that 79 is a technical and probably factual bottom. And yet we're trading at 88. You know, for oil, that's nothing, isn't it? That tells me that really the demand isn't that huge. And, you know, therefore, why would I think that something like DBC is about to spike hugely? And here we have DBC. So DBC really is very, very well contained. It's where it's been for the past month, right? This is a weekly chart, 1, 2, 3, 4, 5, 6 weeks, and really it's gone nowhere in 6 weeks. Is it slightly higher than it was 10 weeks ago? Yes, but is it hugely higher? No. So it's roughly contained. And if you have a look at gold against DBC, all it's doing is basically unsustainable. It's going back to this 200-day moving average, which is now flatlining, and we'll be trading 736 soon. So basically it's saying gold might be slightly better than DBC. DBC is 60% oil. Oil is going nowhere, even though it's got a $79 floor. This all tells me that the market is not pricing in some kind of hellish geopolitical event. In fact, that it's doubting it. And why should gold go through the levels that I showed you in that case? Let's have a look at those again. To me, 2045, or even this kind of level, 2025, is seen. It's an opportunity to start getting short now. Something like 1 month call spreads, something like 2025, 1925, if they give them to you for, something cheap, or even doing 1 by 1.5. Let's see what the pricing is when we get there. It's interesting to have a look at what happened to American Express on Friday, just after it released its earnings. So it traded up and then it just collapsed. And where is it now? American Express, it's exactly at the same level as it traded at the beginning of the year, i.e. it's at the lows of the year. It just shows you that 99% of stocks are going nowhere because bond yields just will not allow them to go anywhere. 2.5% real rates is enormously high hurdle for stocks to price in any outsized level of growth. And what are we pricing in? We're pricing in about 25% higher earnings over the course of 2024 and 2025. I'll leave it to you to judge how likely that is. I mean, in nominal terms, that can only happen if inflation is much higher than the Fed anticipates or that the Fed is targeting. So you really would have to believe in some kind of fiscal dominance argument or the Fed abandoning its inflation targets to believe that nominal earnings can grow 25% or so over the course of 2 years. And the market here obviously is saying that they don't believe that is going to happen. Okay, they don't believe that fiscal dominance is going to happen because otherwise American Express would not be trading at the lows of the year. Let's have a look at the two stocks that will be reporting this week, Microsoft and Google, and that have been basically carrying the market. Yeah, what to say? Yeah, Microsoft, if it's a buy the rumor, sell the fact, because the earnings should be fine. The earnings should be great. We know that GDP grew at close to 5% last quarter, and we know that the economy is just fine. So earnings should beat, and the guidance should be decent. I mean, even American Express did not give you bad guidance, but the market still sold it by 10%. So that is what I am looking for in terms of direction for the indices. I'm looking for Microsoft and Google. If they have the same reaction, and this is now Google, if they have the same reaction, they could easily fall to the bottom of the Bollinger Bands in Google. What's that? That's, easily another $7. So you could get a 4-5% move on good earnings to the downside. Now, if that happens, I am sure that there'll be rotation into defensive stocks and so on, and then the Nasdaq can fall probably 3-4% without touching the sides. So those are the odds. I certainly would not be long of these stocks into earnings, and I think the risk reward is for the next week in technology to the downside, because I think we're going to have the same kind of reaction as we had with Amex. Thank you very much for the blowout quarter from last week, from the last quarter. But what are you going to do for me, not in the next quarter where you're giving me guidance for, but for the next year or two? So now I have a look. Let's have a look at the clean chart for the SPX and the clean levels. I think it's very, very unlikely, given the close on Friday and what we, at some stage during the course of the week, we trade in here, which is 41.66 to 41.20 odd in terms of SPX. Very, very likely to go in there and test and fill some gaps. And that will be pivotal. What we do there will be pivotal. And it'll naturally depend on Google, and it'll depend on Meta, and it'll depend on Microsoft. So until and unless I see these levels broken, I have to think that they're going to be very, very good support. And as you can see, I don't think the support really, there is no big support through there until we get to 4,000. And we, basically start challenging where we started the year. Is that possible? Yeah, I think the odds are not great that we start doing it at the moment, because that would really mean complete risk off. And risk off means that you start buying bonds. But we shall see, with the QRA coming, I don't think the market is ready to go into complete risk off, because, bonds are still not bid and will not remain bid. But that would mean a big change in the yield curve, and we will see what happens. I'm just very doubtful that we can fall through these levels now. Certainly not for the next week. After that, I'm much less skeptical, but I really think that these are the levels that you want to have very short-term call spreads, because the market will squeeze up. Unless, of course, we have a disaster in tech, and that's what we need to look for. So now this is NDX, and I like this 14,200 level. Maybe spike through it and get everybody short. But we shall see. I really don't see that we are in a position yet to completely fall apart, because the weekly chart, it would mean going straight through the bottom of the Bollinger Bands. Can we do it? Yes, but then we bounce. So I don't think we're in a position yet to do it. Can it happen? Yeah, and I really think that it's going to be a result of all the earnings that we get next week. I certainly think the upside is very limited, because if we do have a buy the rumor, sell the fact on those earnings, it's much more likely to, stop everyone out here below this 14,400 level, go down to 14,000, 100, 200, and then squeeze back. That is far more likely to happen than not. So that is the kind of thing that I'm looking at. I'm not looking for a complete collapse. I think this 38.2% retracement around the 13,009, and don't forget this is NDX, not the futures, is going to be very, very good support. People have to start buying something, and I think that tech is really going to be much better bid, than continue to be much better bid than anything else. I've heard lots of arguments why the US will go into a fiscal dominance cycle, and really people talk a lot of rubbish. But one of the arguments that could be made is because they're going to be fighting wars on like 200 fronts. Okay. Could it happen? Yeah, absolutely. I think the odds are like almost zero, but it could definitely happen. But if you really believe that that is going to happen, what do you buy? Do you buy gold or do you buy Ether? Look at Ether. It's now as low as it's been since the geopolitical trouble started. It basically can't hold these levels. And even if you look at it, Ether against SPY, it's hardly going up like crazy. Let's go back to the time when we bought Ether around these levels and rode it all the way up. It's just going sideways like it did here. If you truly believed in fiscal dominance, you would be buying the companies that are going to most benefit from it. And that is the defense sector. Because if there is going to be fiscal dominance and they're going to be issuing all these trillions of bonds and spending all this money on armaments, well, who's going to make that money if not the components of Ether? So why are you not buying Ether? Why are you not buying it huge against the SPY? And why are you not buying it huge outright? So that argument to me is rubbish for the time being. The market is just not validating it. But I do think that this is where your bid for Ether is, around 96. 96, 97 is where your bid for Ether is. A nice ABC, everybody gives up, and that's where you start buying defense stocks again. So now let's have a look at the reason why I believe there will be some kind of buy the rumor, sell the fact in the tech stocks, because every time we've closed above 2060 in the VIX, we've actually reached this 2279. And that indicates to me that at some stage next week, we get a downdraft. And if we try to match that with my clean chart that I showed you earlier, that to me says that these lows here, where there must be a whole load of stops, right? You know, there'll be a load of stops, get eventually taken out, whether it doesn't have to be Monday, it can be Wednesday, right? When after the earnings, or Thursday after the earnings, we go down into that box. But I think the risk reward into that box is definitely to cover shorts, if not to start looking to go long, because I don't think yet we are in a position to abandon the stocks in favor of bonds. Let's wait for the QRA to do that, but I think next week that area stops it. I've updated all the levels. As I told you, I think it's time to do the right thing by risk reward and just watch what the yield curve does next week, because there is no edge. You know, the edge will come after the QRA, not before it. It could very well be that people just basically push it to an extreme to sell the fact. So again, the risk reward is to get out of all US Germany and even the Bund BTP. That is what risk reward says, and I follow risk reward. So these spreads are going to be out. I think the support in SPX is going to be very much around that level, and the fact that VIX closed above 2060, and that'll be my sort of guiding star next week. Are we going well above 2060? Are we going to 2280? If 2280 trades, I'll be out, because I think that's enough of any kind of hedges and shorts. And what I've included here for you is the explainer that Andy Constant did a couple of days ago. I was going to do one as well on tips, but he's done it so much better than I ever could that, you know, he's just a much better teacher than I am. I agree with everything he says. So if you want to know why tips are a much better longer term bet here than gold, or anything else for that matter, I believe, watch that explainer. To me, gold at 2045 is a golden opportunity, to actually do some put spreads or sell some call spreads or something. We shall see what the pricing is when he gets there. Thank you very much indeed, and have a wonderful weekend. Tweet you tomorrow.